Between 2007 and 2023, iron ore giant Fortescue Metals returned a staggering 4,645%. Between 2006 and 2023, mineral resources returned, get this, 4,689%. And from 2010 to 2023, Northern Star Resources returned 1,348%. Now, these returns seem absolutely staggering, and everybody, I'm sure, who invests in a resource company wants to do something like that. But how do you do it? Well, that is what my guest today, Brian, reveals in his insight today for Fat Tail Daily. Brian, welcome, mate. How you doing?
Hey, Woody. I'm doing all right. How about yourself?
I'm good, thank you. Now, I just wanted to get those returns in because they're factually correct.
Yeah.
They happen between a set time frame over a number of years. And today's article, you want to try and get across to people how you can best give yourself the best chance of making that kind of investment possible. Now, you make a point in the first part of it that most investors try and do the wrong thing. And what they do is try and wait for a move to happen and chase momentum. But you say this is wrong, and it's certainly not the approach you take. You cite lithium stocks going crazy as an example. People to really chase lithium stocks up. I remember back in 2016, there was that was the proper first lithium craze, and momentum went into the lithium shares. Didn't last very long. They inevitably corrected. You see it with uranium stocks. You hear it about China and the rare earth story as well. And your point is that you never really start to build up expertise in that one sector because you're always chasing short-term performance and the next hot thing. So you're going to try and debunk that way of thinking in today's article, aren't you?
Well, Woody, if the way you're putting it like that would make me not a very good. I'll be a what do you call it? Persona non grata to my esteemed colleagues Callum Newman and Murray Dawes, because they would definitely be slamming the table and going, "That is wrong.
Chase
wrong,
momentum.
Wrong, right?" Because that's their newsletter service. That's where they make their that's where they help their readers make their returns. And with absolute due respect to them, because in many ways they're more likely to generate gains to keep the newsletter readers happier than the strategy which I use, which may require significant discipline, a lot of patience. And I can tell you this, the last 3.5 years, even though I have gone through, this is my third gold stock bull market in my 11 years of focusing on gold stocks, there are times where I feel quite down about what's been happening and wondering, should I just go and follow momentum rather than do what I've been doing for 11 years? It is not easy. And you're absolutely right. What I want to talk about today is the mindset, the strategy of the most successful mining stock investors. And this is how they do it. They go through the cycles of a commodity and go against the trend. And that's where they make their huge returns over 10, 20, 30 years.
Now, we've on purposely titled this video, "How to Find the Next Fortescue," right? And that's it's akin to saying, well, how do you find the next Microsoft or whatever it is? It's what, it's almost a cliche headline, but there's a serious point behind it. Now, the whole point is that you're emphasizing the importance of buying early and holding for the long term for your expertise, the gold market. So how can individual investors develop that discipline to stick with their investments through the inevitable ups and downs of commodity cycles? And obviously the commodity that you focus on is gold, but you could probably relay this to any commodity or any sector, really.
Yeah, that's right. And it's easier said than done. I am talking from a benefit of hindsight because I was one of those who managed to get that right back in 2014 and 2013 and 2014. I chose a selection of gold producers that were slammed probably as much as 80-90% from their peak in 2012. And I held them through the toughest period in 2013 to 14 and watched them recover as gold did in 2015 to 2016. I did the same in 2017 and 2018 for the 2019-2020 boom. You want to say something too?
I did. I just want to ask a quick question on that front, because I know you strategically buy throughout the down period, right? So it wasn't like you bought at the peak and just held on for it to recover. So you made a judgment on the company itself, and then you would strategically buy at certain intervals so that you were capturing a lower entry price. I'll bet you had to, maybe I'd imagine, hold your nose and buy sometimes.
Yes, you're absolutely right. And I can clearly remember what article it was that got me to adopt that thinking. And unfortunately, that website no longer exists, but it was Takoa de Silva's bull market thinking. And he was talking in about 2013 when gold stocks were coming down. And he was saying there's a difference between people who buy at dollar cost average when prices are going up, as in you're chasing momentum, versus people who dollar cost average when the share price comes down. Now, the key assumption that you are making in dollar cost averaging and succeeding in that strategy is the company has to be pretty good quality. The company has to have projects which are valuable so that when the cycle moves back in the company's favor, that the share price is going to go up. You can't dollar cost averaging succeed for a company that is just simply a hole in the ground with a salesman at the entrance, because you will just dollar cost average your way to oblivion. And we've seen many cases where that has happened, and I also have succumbed to that myself. I'm by no means able to do it every single time. There are companies where I dollar cost average down till the company, the thesis basically no longer existed, and I left with huge losses and quite a bit of humble pie. But the other companies where I did read it right, they were the ones who turned around. And yes, there are times when you feel that it is stupid to buy, you still buy because the story for that company is still there. And that's what delivers the value when the commodity, in my case gold, turns around and these companies generated triple-digit percentage gains. And in a few cases like Ramelius Resources, St. Barbara Mines, and Resolute Mining and Red 5, in my last 10 to 12 years, I made six-figure returns, investing about $25,000 into these companies throughout my holding period. And I still hold some of these to this day because those companies are quite cyclical.
Yeah. Yeah, and I guess when you're in a number of you're concentrating in the sector, but when you're diversified enough into the many different companies that you analyze, the whole point is that you're not all concentrating in the one stock that goes down. So, but that's a good thing to point out. You mentioned the recent bear market in gold explorers and early stage developers in your piece. What key indicators do you look for to identify when a sector might be nearing the end of a down cycle and potentially poised for a turnaround?
Yeah, so in this case, fundamentals tell you which companies to select, but because commodities are highly cyclical, whether it's gold, silver, oil, base metals, etc., and critical metals, they are driven a lot by narrative from governments and international agencies that are driving where businesses are going to go and where fund managers are going to invest. So with resources stocks, if you just focus on the fundamentals, it will be a very rough ride because there'll be extended periods where no one is interested in that commodity. No matter how good the company is, you will only get maybe 2 or 3 or even 5 companies that will trade against the bear cycle and do well. Good luck in trying to find those among the sea of unloved resources companies. In that case, a hat tip to those who use technical indicators, because they will perennially identify which companies are the momentum indicators are in their favor and you're going to buy. But in our case, we look for what's happening with the commodity price. And in the case of gold explorers, it's an interesting one, because when gold enters a bull market, the first companies to move are the larger producers, because they're the ones generating cash flow. Their operating margins are going to improve, and they are the low-hanging fruit. They also possibly more than $1 billion, so fund managers are going to shift into these much easier. Whereas on the other end of the spectrum, the explorers and the early stage developers, the market value of these companies are usually below $100 million. And as a result, most funds will not permit these companies to be in the portfolio because the mandate won't allow for it. So it's the specialist resource funds, sophisticated investors, and ordinary investors like you and I who are in this space. And if the trading volume is very low because these companies are unloved, very small movements are going to cause these share prices to get pummeled. We're watching that, but a handful of companies are actually breaking out of their low trading volume and double-digit price movements up and down, giving it back. They're actually now gaining momentum. So those are key signs that there are new investors coming into this space besides the die-hard faithfuls that have been holding on for these few years. Third thing is, I created my own speculative gold stocks index, which tracks the performance of about 70 odd ASX listed explorers and early stage developers. And we are seeing that index rise about 60%, 70% higher from its all-time lows in this cycle. Sorry, it should be this cycle lows in March 2023. So the momentum is picking up from there in the index and also in the companies and the producers themselves. I'm also seeing them kind of hit this barrier and they're not quite breaking through. So you got investors probably going, I'm taking profits from the producers. I want to go somewhere. And they're going, ooh, explorers and early stage developers look great. Let's go and start buying there. And that's where the momentum is going to pick up in the speculative gold stock space. And that's where it gets really exciting.
Yeah, I guess you actually do like momentum, right? Because you're already going to be in place to take advantage of it rather than chasing momentum. But that's one of the differences you highlight, the difference between chasing momentum and building expertise in a sector. How can retail, ordinary, on the street investors effectively build knowledge and expertise in a specific resource sector without having access to professional resources?
Well, this is a very good question to ask. In this case, is you need pretty specialized knowledge about geology, about mining engineering, about the different companies out there, their financial statements, and also being able to understand a bit of market psychology. Now, none of these are what we learned at school. Most of these are in specialized university courses, or you got to pick up a book to build yourself that knowledge. And most people might not have the time to get into the nitty-gritty of it. And that's where people like myself come into coming to
I was
the
going to
scene.
say, or you can subscribe to a newsletter.
Yeah, exactly. Just being really shameless here. Coming from a Hong Kong background, I really don't like talking my book, and I prefer people to actually point to me rather than myself doing it. So I'm going out of my my heritage in doing this. But there are a handful of experts in this space in Australia that I also read about to learn about what they do. So we had Headley Widdup last week. James Cooper interviewed him, and he's been in this area for quite a bit as well. He's a geologist by profession, just like James Cooper. And we also, I'm aware that you got the various resources news sites like mining.com.au and smallcaps.com.au. They provide updates on companies, but they don't get into detail that we do. And I think the ordinary investor, the Joe and the Joes and the Janes, should try and clue in with people who are on the field and also very much in the rhythm of things rather than try to do it themselves. Because there's just so many companies that you could randomly throw your dollars at and expect very little back. And I can tell you from my experience, it took me a while to start buying into explorers and developers. I used to just think producers, that's already good enough. But once I got into explorer space, I realized I was quite out of my depth and I needed to spend quite a lot of time to get used to how the game works in this. And that's where experts come in. And and I think that's the most important thing for people to keep in mind.
That's a good. It kind of leads nicely into my last question for you, really, Brian. It's literally about the difference between producers and explorers. So, given the cyclical nature of resource stocks, how would you advise people? Bearing in mind, of course, isn't personal advice. You don't know anyone's personal situations, and this is, it's not one to one. So, but how would you advise investors interested in resources to balance their portfolios that they're devoted to this space between established producers like Fortescue Metals and more speculative early stage companies? Are there like any specific risk management strategies that you can just give away to people now to maybe give them a bit of a takeaway?
So I can provide the concept and allow people to digest this rather than giving them formulaic approaches. So I always believe that one should look at having some physical gold bullion and silver bullion handy as personal wealth stored away for the rainy day and passing it to future generations. And then you should have some exposure. You could have some exposure to commodity ETFs, so like Perth Mint Gold, GLD, Global Silver X, Global X Silver, and also the other base metals ETFs. So you can allow yourself to circulate between speculating on the commodity price versus the mining stocks, because at certain stages, the commodity is going to be a less volatile trade than buying the individual mining stocks. And then in terms of the mining stocks, there are established producers, late-stage developers, early-stage developers, and explorers. I always believe that it's prudent to have a larger proportion of exposure to producers than the developers and explorers, simply because companies that are generating revenue, they have a track record. They also are more likely to survive through the difficult times. You have to do your research to look at which producers are cyclicals and which producers are able to grow over time. And I talked about that in last week's article. Then when it comes to the developers and explorers, probably hold a small proportion of the portfolio. I usually would say no more than 10-15%, simply because you can potentially lose everything in those. And the worst thing you could do to yourself is lose a huge amount. And if that is a large proportion of the portfolio, it's hard to get back on your feet.
Yeah.
So I would always say safety first, no matter what the cycle, what stage of the cycle we're in for any commodity. Once you're in a position of safety, then you can speculate more wildly, which is one of the titles of our videos, I think probably 2 or 3 weeks ago.
Wildly, but with calculation. I will end there. Thank you, Brian. We've got an event coming up at some point this month, but yeah, lots to be excited about. Thanks for your insights today. If you would like to check out Brian's Fat Tail Daily piece, there's a link in the description below, and there's a link to a sign-up page as well. Hope you can join us on the journey ahead. Thank you, Brian. Much appreciated.
Thanks very much, and God bless.